Welcome back to the Deep Dive. Today we are digging through a ton of material from EOG Resources, Inc. We've got strategy docs, Q3 2025 earnings call notes, SEC filings. The works.
Yeah, quite a pile.
It is. But we have a clear mission here.
Yeah.
We want to cut through the corporate speak and really unpack the strategy. How does this specific company manage to get such high returns cycle after cycle?
A good question. They operate in a notoriously volatile industry.
Exactly. And I think we have to start with the big number, the one that kind of defines everything for them.
The commitment.
Yeah, that commitment. Return a minimum of 70% of their annual free cash flow FCF back to shareholders.
Minimum 70%.
That promise, it's not just a target, right? It feels like it really drives everything they do, from the wellhead to, well, the dividend check.
It absolutely does. It forces discipline. They talk about 4 strategic pillars: capital discipline, operational excellence, sustainability, and culture. But really, they all just prop up that 70% FCF promise. It's about creating value through the cycles, not just chasing the highest production number. Profitability, that's the focus.
And we can actually see that in the numbers, can't we? When we look back historically, we're talking ROCE here, return on capital employed.
Exactly. That's their key metric. EOG wants to be the high return leader, and, well, they often are. Think back to 2022, oil prices were high, everyone was doing okay.
A rising tide lifts all boats, sort of.
Sort of, but EOG hit a, frankly, staggering 36% ROCE that year.
36%.
Now compare that, the peer average for the same year, 16%. 16.
Wow. Okay, so that's more than double.
It's a huge difference.
So that suggests, while everyone had cash coming in, maybe the others were pouring it back into growth at any cost. Lower quality projects just to boost volume, while EOG stuck to its guns on returns.
That's exactly what it implies. Discipline means saying no sometimes. Even when prices are high, if a project doesn't meet their internal threshold, they won't do it. They cap reinvestment to protect that capital return.
Protect the dividend and buybacks.
And speaking of that return, they don't just, squeak over the 70% floor. They blow past it.
Right, you're talking about the actual cash that went out the door recently.
Yeah. The main way they return cash is the regular dividend, which, they just boosted again, by the way. The board declared $1.02 per share quarterly back in November 25.
Okay, a growing dividend. That's key for income investors.
For sure. But beyond that baseline, in a recent period, they returned $5.3 billion. That worked out to be 98% of their annual free cash flow.
Wait, hang on. 98%.
98.
Okay, that's near everything. Now, I have to ask the obvious question. That looks great for shareholders today, but is returning almost all your FCF sustainable? Does that leave enough cushion? What if there's a big, unexpected capital need? A surprise acquisition opportunity, or, a major operational issue?
That's a really, really good question. And it's a fair one. I think their answer would be twofold. One, they've historically kept a very strong balance sheet. Low debt gives you flexibility. Two, their whole operational excellence push is designed precisely to avoid those major unexpected setbacks.
Betting on their own execution.
Basically, yes. They're implicitly betting that their low-cost model, their efficiency, means they won't need a massive rainy day fund kept back from shareholders. They believe in their assets and their team to manage the risks.
Okay, that makes sense. The discipline sets the stage, but it only works if you're incredibly efficient. So how do they actually get those low costs? How do they generate that much FCF to begin with?
Now we get to the engine room.
The iTech.
Exactly. The proprietary technology and, just as importantly, the in-house expertise. It's not just about buying fancy software. They build their own.
Yeah, we see all those catchy names. iWellPlanner, iSteer, iRig, iMotor, iCompletions, iMap, iSense. The list goes on.
Right, and it's integrated. Think about iWellPlanner. It's not just drawing lines on a map. It pulls in geology, seismic, economics, everything to find the absolute optimal path for each well. Then tools like iSteer and iRig. They're the execution. iSteer uses real-time data feeds to guide the drill bit precisely along that planned path, keeping it in the sweet spot.
So it's like moving from just, paving a road to building a high-speed GPS-guided train track for every single well.
That's a pretty good analogy, actually. And that precision, that focus on execution efficiency, it delivers really big, tangible gains.
We're not talking small tweaks here.
No. Look at 2024. In the Delaware Basin, a key area for them, they boosted drilled feet per day by around 10%. Okay, that's good. But completed lateral feet per day, that jumped by roughly 20%.
20% faster completions. That's huge.
It is. And for 2025, the plan is to push the average lateral length length even further, by over 20% more.
So if you could drill 20% longer wells in the same amount of time, that slashes your cost per foot, gets more oil and gas out from each pad. Is that kind of gain a one-off, though? Or is it the tech constantly improving things?
The documents suggest it's continuous improvement. They credit these tools, plus specific techniques like their super zipper completion method and continuous pumping operations. It's all about minimizing downtime.
Keeping the machine running.
Exactly. And it's not just the Permian. South Texas Eagle Ford, the Dorado play, both saw similar jumps, like 15 to 20% increases in drilling and completion speeds.
Okay, so there's squeezing costs hard on the operations side using this in-house tech. But FCF is also about revenue, right? Maximizing the top line. You need the best price for your product. How do they manage that?
Same philosophy, really. Control. Their marketing arm tries to avoid just handing off barrels to middlemen.
Yeah.
They want physical and contractual control from the, well, right to the final sales point.
More integration.
And that control lets them play the field, basically. Access diverse markets. You mentioned the Rockies, Permian, Gulf Coast, Cushing, plus crucial export markets. It gives them options, diversification across geography, product type, pricing benchmarks.
But does it actually work? Does the data show they get better prices than their competitors?
It does, pretty clearly, actually. In 2024, their price realizations led the pack. They got $2.96 per barrel more for their oil than the peer average.
Almost $3 a barrel. That adds up fast.
It does. And on the natural gas side, it was $1.18 per thousand cubic feet higher than average. That's pure margin enhancement, dropping straight to the FCF line.
And I imagine the export capability is a big piece of the oil price premium.
Yeah.
Getting access to, like, Brent pricing.
Absolutely crucial. They've locked up export-linked capacity of 250,000 barrels per day. Being able to tie sales to those international benchmarks when they're favorable gave them an estimated $85 million net revenue boost in 2024 alone.
$85 million just from smart marketing and logistics.
It's a significant edge, supported by that strategic positioning.
Okay, so we've got the strategy. Cost control via tech, margin maximization via marketing, all feeding that FCF commitment. But to keep growing that FCF, you need inventory, you need scale. Which brings us to the big news from Q3 2025.
The Utica acquisition, yep.
This was a major move. Tell us about it.
It really reset things, near term anyway. August 1st, 2025, they closed the deal to buy Encino Acquisition Partners, the main prize, the Utica shale gas play.
How much acreage?
675,000 core net acres in the Utica, a huge position.
And it wasn't cheap.
Yeah.
This changed their balance sheet profile, didn't it? Let's talk money.
Right. Total cash paid was $4.484 billion. Billion with a B, plus they took on and then immediately paid off another $1.2 billion of Encino's debt.
Okay, so over $5.6 billion total value. How did they fund that?
Mostly debt. They issued $3.47 billion in new long-term senior notes.
So that definitely levered them up a bit. Shows how important they felt getting those Utica assets was.
It did. You look at their debt-to-total capitalization ratio, it went from a very conservative 14% at the end of 2024.
Super low.
Yeah, very low. Jumped to 20% by the end of September 2025, right after the deal closed. Now, 20% is still pretty manageable in this industry.
Sure.
But for EOG, known for being almost debt-averse historically, that's a noticeable shift. Signals the strategic weight of this natural gas expansion.
And it immediately showed up in the production numbers, right? Q3 25 versus Q3 24.
Oh, yeah. Big jumps across the board. Mostly the new Utica gas plus ongoing Permian work. Crude and condensate volumes up 8%, NGLs up 22%, and natural gas, that was the big one, up 39%.
39% gas growth. Clearly positioning for the future of gas.
No doubt. Locking in that long-term inventory to feed the FCF machine down the road.
But it wasn't all smooth sailing in the quarter. Those volume gains ran headfirst into some price headwinds. Shows you can't control everything.
You really can't. Commodity prices going to do what they do. Their average realized price for crude oil actually dropped 14% in Q3 25 compared to Q3 24. Fell from nearly $77 a barrel down to about $66.
Ouch.
Yeah. So that price drop took a bite out of the revenue uplift from the new volumes. It's that constant tension between operational gains and market volatility.
Right. Okay, before we wrap, we should touch on that fourth pillar. Sustainability. Sometimes this feels like a PR exercise for companies, but EOG seems to frame it with the same kind of operational focus.
I think they do. It ties back to risk management and efficiency. They set a new greenhouse gas emissions intensity target, a 25% reduction by 2030 compared to 2019 levels.
Quantifiable target.
Exactly.
Okay.
And they're using tech to back it up, which brings us back
To the ice suite again.
You guessed it. Specifically, their ISIN's continuous leak detection system. This isn't just about ticking a regulatory box, it's about stopping methane leaks, which means less lost product, better safety, better operations.
Makes sense.
They noted they had 99% coverage with ISINs in the Delaware Basin by the end of 2024. That's pretty comprehensive monitoring. It reduces risk and shows that focus on precision everywhere.
Okay, this has been quite the deep dive. So if we boil it down for you, the listener, EOG's strategy looks like this closed loop, strict capital limits dictating everything.
That's 70% FCF return minimum.
Right. That achieving that through superior operational efficiency, driven by their own integrated proprietary tech.
Getting costs down.
And finally, maximizing the value of every molecule they produce through smart, controlled marketing and logistics.
Get the highest price possible. It's really an architecture built to deliver low-cost barrels and high returns, period. The whole thing rests on constantly innovating internally to stay ahead on costs so they can keep that FCF promise, good times and bad.
And that technology piece, it really feels like the absolute linchpin, doesn't it? Because that competitive advantage we just spent time detailing, it seems to hinge almost entirely on these advanced proprietary tools, the iTech and the real-time data they give employees. So here's the final thought for you to chew on. What happens to that advantage if, or maybe when, those tools aren't exclusive anymore? What if competitors manage to copy them or develop something just as good? Where does the edge come from then?
It means they can never stop investing in R&D, can they? It's a constant race to stay ahead. Defending that technological moat becomes critical.
An innovation treadmill they can't afford to step off. Something to think about when you're looking at EOG and its peers. Thanks for diving deep with us today.